As it turns out, this is a really good metaphor for Federal Reserve Chairman Jerome Powell's job. Amid many challenges, Powell and the rest of the Fed are still walking a tightrope in their efforts to normalize monetary policy after years and years of quantitative easing. So how is this high-wire act impacting the bond market and the markets overall? And what exactly might happen if they fall? It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. If you follow the news, then you know that the Federal Reserve has been making a lot of it lately. Donald Trump has criticized the Fed's hawkish pace on raising short-term interest rates, blaming the Fed for much of the extreme volatility the stock market has experienced so far this year. Then, when Fed Chairman Jerome Powell struck a more dovish tone in his most recent speech just last month, the markets briefly rallied, but only to quickly pull back again. Meanwhile, a major new set of concerns have emerged about a flattening yield curve, slowing inflation, and of course that old favorite, a so-called bursting of the bond bubble, all tied to the Fed's ongoing tightrope walk. We're to sort it all out for you today with the help of guests. First, noted financial analyst and author Dr. Gary Shilling, and also financial advisor Anthony Siccaro. But first, let's take a closer look at that most recent address by Jerome Powell and what it may or may not mean for the markets and for the economy heading into 2019.
Congress assigned the Federal Reserve the job of promoting maximum employment and price stability, and I'm pleased to say that our economy is now close to both of those objectives.
Oftentimes what a person says and what people hear are two totally different things. And that's as much the case when it comes to Fed Chairman Jerome Powell as well as anything else. But it's an especially important fact where he's concerned because his words, and not just the Fed's actions, can have major impacts. And that's been increasingly true ever since former Fed Chairman Ben Bernanke launched an unprecedented monetary effort in response to the financial crisis. That effort resulted in 3 rounds of quantitative easing over 7 years. And in today's new age of unchecked artificial stimulus, the interpretation or perhaps misinterpretation of a single word by the head of the Fed can send markets all over the world soaring or falling. We've seen it numerous times in the last 10 years, most recently with Chairman Powell's November speech to the Economic Club of New York. Wall Street honed in on one particular line in this address, when Powell called interest rates just below what would be considered, quote, neutral, close quote. That was interpreted as a reversal of his assessment from just a month earlier when he called rates a long way from neutral. As a result of his latest remark, the Dow Jones Industrial Average leapt to a 618-point gain in one day. That helped temporarily lessen some of the pain the market had experienced since Powell's October comment. But October was an especially volatile month for the markets. The Dow hit its highest number of losing days since 2008, while both the NASDAQ and the S&P 500 were in correction territory for a good part of the month of October. Of course, the Federal Reserve wasn't the only driver of all that volatility, as we've discussed recently on several episodes. But the market's quick spike in response to Powell's near-neutral remark was a clear sign, it seems to me, that Wall Street is not only still hanging on his every word, but also looking for any hint of optimism. That's optimism wherever it can find it. So why would his remarks be considered optimistic news? Because they were interpreted as a sign that the Fed plans to slow down its schedule for raising short-term interest rates, which had held actually near zero for 7 years in conjunction with quantitative easing. The president has consistently criticized the Fed's pace on raising rates as being too aggressive, particularly in light of all the other economic certainties that have rocked the financial markets this year. And despite a lot of good economic news, such as record low unemployment, GDP growth actually topping 4% in the second quarter, Analysts and economists have pointed to potential storm clouds gathering around issues such as Trump's trade war, the federal deficit, increasing uncertainty economically speaking about what's going on abroad, the recent power shift in Washington, and a problem that I forecast years ago, and that is the dangers of a flattening yield curve. We'll talk much more about that in just a bit. You know, the contrast between so much good economic data this year and the existence of so many potential threats actually illustrates the tricky challenges of the Federal Reserve's tightrope walk, as I like to call it. If they slow their pace on raising short-term rates or even suggest they're going to do it, it could be taken as a sign of their confidence in the economy and their confidence that it's actually waning, and that they might even see a new recession on the horizon. On the other hand, if they stick to their schedule, which includes one more rate hike this year and at least 3 in 2019, and that pace turns out to be really too aggressive for the economy, it could actually trigger and create the next recession. In either case, the result could be dismay on Wall Street and the next sustained major market plunge. Naturally, there's also a chance the Fed could maintain its footing and complete the tightrope walk successfully, in which case they'd be moving at just the right pace, with Chairman Powell saying just the right things to keep big investors calm all along the way. Now, that's possible, but it won't be easy in the midst of so many uncertainties and in the light of two emerging challenges in particular. And those are stalling inflation and especially a strong resistance level or glass ceiling for long-term interest rates that increasingly poses the threat of a flattened yield curve. Now, I've discussed these challenges on this show before, but there have been some new developments around them that I believe everyday investors really should know about. And we'll break those down in just a bit and talk about what the Fed's tightrope walk, depending on how it goes, could potentially mean for bond investors in particular. But right now, it's time to welcome our first guest, Gary Shilling. Gary Shilling is a financial analyst, author, and commentator whose work appears regularly in publications such as Forbes, the New York Times, and the Wall Street Journal. He's president of Gary Shilling & Company Incorporated and the editor of Gary Shilling's Insight. He's a featured guest on all the top financial shows, and of course, we're very pleased to have him with us today. Gary, welcome to the show.
Glad to be with you.
Hey, so tell us, how have you been putting this in perspective for your readers, your listeners, clients, all the market volatility this year, and I guess particularly the wee little bit of market volatility we've had so far this week?
Well, I think what looks like is happening is we're in the prelude to a recession. As a matter of fact, in our November issue of our monthly newsletter, Insight, I listed 13 pre-recession indicators. I might just mention very, very briefly. Output exceeds capacity. That's what the numbers show, and that's typical going into recession. Stocks are falling. They're a leading indicator. Central banks are tightening. They always do and end up precipitating a recession. Yield curve, I know we're going to talk about that. That's near inversion, and that's always been, when it does, it's always had a recession. Junk bond treasury spread is opening. Another indication people are worried about weak credits. Housing activity declines. Housing is very interest rate sensitive, and when the Fed raises rates, it's the first major sector of the economy to decline, and it is. Corporate profits growth is falling. We're coming off of tax cut effects, and earnings are tougher to come by with rising wages. Consumers are optimistic. They always are at the peak. Peak, as a matter of fact, that's the peak in consumer optimism. Global lending indicators are dropping. You look at OECD measures, others, they are uniformly falling. Commodity prices decline. Again, that's an early indicator. Things that we have in our portfolios, copper and oil, they're declining. Data revisions, that's always happens at peaks. When they get more data and things are falling, the data revisions are down and troughs are up, but now they're coming in down. Emerging market troubles mount. We've written a lot about that. And finally, of course, we got the U.S.-China trade war, which is escalating. So all those things, There's nothing that says definitely in a recession, but there's a lot of indicators that we're headed that way.
So it's funny, I didn't think you were going to get to the U.S. trade war, and I was going to find humor in that on the fact that I agree that's not the biggest factor. That probably should be near the end. But yet the media is putting so much pressure. They're always talking about this. Every time there's a tweet or an issue, it's always about the trade war. But you seem to agree with me that that's not the biggest indicator. There's lots of other issues out there that are causing it.
List those in particular order. I'm not smart enough to have that kind of discernment. I think they're all important.
Okay. So the flattening yield curve. Now, I had Mohammed Alarian on the show a while ago who said, well, this time I'm not worried about the flattening yield curve, because when a flattening yield curve happens organically because there's not enough GDP to put the long end interest rates, make them higher, then when the flattening yield curve, when the long end is being held down artificially by low interest rates in Europe, then it shouldn't be an indicator anymore of a recession. So he wasn't concerned about a flat yield curve. Your thoughts?
Sir John Templeton said the most dangerous part is different. All you can say is that every time the yield curve is inverted in the post-World War II period, you've had a recession. Now, those are statistics. They aren't indicate causality. But what it does tell you is that the Fed is raising rates, pushing up short rates. But on the long end, you're not getting nearly the spillover effect, in part because you never do. The further you get out on the yield curve, the less the spillover from Fed action is. But also, it means that investors are looking ahead and they're saying, wait a minute, maybe the economy is going to be a little softer. And as a result, interest rates are not going to go up, they may go down. Mm-hmm. And in this case, we think that there are strong deflationary forces in the world which will push them down. So,
and I agree, I agree, Gary, with one thing you said, that the Federal Reserve often bumps rates up too high, and actually create the next recession. And I think that's one of the bigger factors. So we need to leave it there for this segment. We'll be right back in a moment. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
So when former Federal Reserve Chairman Janet Yellen first laid out the Fed's plan for raising short-term rates up from 0, she cited several benchmarks as necessary to the plan. One of those was achieving a sustained inflation rate of 2%, which I will talk more about in just a bit. But more importantly, economic fundamentals have always dictated that the Fed's pace on short-term rates was also dependent on the direction of long-term interest rates. Long-term rates began notching steadily higher last year, and in May, the yield on the 10-year Treasury rate finally topped 3% again for the first time in 5 years. Predictably, the movement triggered talk among some analysts about the so-called bursting of a bond bubble. In fact, fear over rising rates has been another major factor in all the stock market volatility that we've seen, particularly early this year. Now, despite all that fear, long-term rates have since exhibited a strong resistance level, again with just a fancy word for a glass ceiling, at right around 3.25 percentage points. If you're a regular viewer, you may recall this is exactly what I forecast, that for a variety of reasons, long-term rates would hit a glass ceiling at or just above or below somewhere near 3.25. So why is this such a problem for the Federal Reserve? Well, as I've also explained many times in the show, long-term interest rates need to rise ahead of short-term interest rates in order to avoid this dreaded flattening yield curve. Banks depend on an increasing slope to the yield curve in order to make lending money financially worth their while. If there isn't much of a difference between long-term interest rates and short-term interest rates, then credit unions and other lending institutions have very little incentive to approve loans. As a result, borrowing slows, home buying slows, and ultimately the whole economy slows. And that's one reason why a flattening yield curve is often referred to as the bond market's trusty indicator of an upcoming recession. But a narrowing gap between short-term rates and our yield on our own U.S. 10-year Treasury bond is only one warning sign of a flattening yield curve. There are other signs, and they're already flashing red. Last week on December 3rd, the difference between yields on 2- and 5-year U.S. Treasuries, actually the difference dropped into negative territory, where the 2-year bond actually paid more interest than the 5-year bond, and it remained there for most of last week. At the same time, the difference between the 2- and 10-year yields also fell to about 0.13%, which is close to flat. So the difference in the 2-year and 5-year Treasury was actually inverted, and between the 2-year and the 10-year was approaching flat. The current rate on the federal funds is 2.25%, and with the 10-year Treasury rate of 2.9%, even that can look kind of sort of healthy, but only by comparison. Yet if the Fed were to continue moving forward with their goal of Fed funds rates all the way up to 3.5% by 2020, and the long-term interest rates remain stuck at about 3.25 or maybe slightly higher, the result would be a fully flat or inverted yield curve. But even milestones we're already hitting are major warning signs, just as I forecast 3 years ago. In late 2015, when the Fed approved its first interest rate hike after 7 years of holding rates near zero, yours truly actually predicted the dangers of a flat yield curve in an appearance on CNBC's Closing Bell that very same day. Historically, whenever an inverted yield curve is triggered, it results in an economic slump, and usually a pretty significant one. Now, as seen in this Bloomberg chart, a yield curve inversion from early 2000 to 2001 set the stage for the technology bubble bursting, and a much longer period of inversion from the beginning of 2006 through mid-2007 precedented the market crash of 2008 through 2009, leading into the Great Recession, i.e. the financial crisis. Now, as if all this weren't bad enough, the Fed's tightrope walk is made even trickier by the fact that its other key benchmark for raising short-term rates, that is, the 2% inflation rate, may also be in jeopardy. According to new research published last month by the Federal Reserve Bank of San Francisco, there's a good chance inflation could soon fall back below the Fed's 2% target. This study actually suggests that the main cause for inflation finally topping 2% was not really a strengthening economy, but instead so-called acyclical factors, factors that are more temporary in nature. We've already talked about what that could mean for stock market-based investors. But what about the bond market specifically? And what are some other potential brewing issues that bond investors should be aware of? Well, we'll spend some time covering that in just a bit. But now it's time to welcome back Dr. Gary Schilling. So, Gary, it's interesting. We didn't dive into it all, but during the commercial break, you made a comment to me that with all the volatility in the markets over the last week or so, that it's actually been good for your firm and actually been profitable for some of your clients. Tell us just briefly about your philosophy and what you've been able to do to make money while it seems like everyone else has been losing money over the last week or two.
Well, we start with the political, economic, political spheres, financial. We develop a forecast and then see what investment themes drop out. And we don't care whether it's long or short stocks, bonds, currencies, commodities, whatever. But I'll tell you what our portfolio has been recently, and it's been working very well. We're short stocks, U.S. stocks, and we do this mainly through indices. We're not stock pickers. We're short emerging market stocks. They're in trouble. We're also short commodities, copper, and oil, and we're long the dollar, and we're long some 30-year Treasury bonds, because that's I think deflation is now being more discussed, and also it's a safe haven.
Yeah, so you're not concerned about interest rates going up any further. I personally think the 3 1/4 on the 10-year might be the highest we see for a while, and if you own 30-year Treasuries, it sounds like you're in line with that.
Well, I can't tell you where it's going to be next week, but I think that we probably are going to, if we look out any length of time, 3-6 months, we're going to see interest rates distinctly lower. I mean, again, the dollar is a safe haven. You've got foreigners. They have a huge advantage in being in dollars, where our interest rates are higher than they are in most developed countries. There's this whole Trump trade war. Hey, whether you like it or not, it's gaining a lot more respect for the U.S. and where do people go when things are in trouble? Even if we start to trouble,
so Gary,
they go to the dollar and Treasury.
So Gary, tell us then what's different? Have the rules changed for the average investor, and if so, how?
No, they haven't changed. I think we've had a very, very long run. Stocks started rallying in March of 2009. You've had a huge run. And I think the biggest risk right now is complacency. In other words, people have gotten so used to relatively low interest rates, to a stock market that just kept going up, 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 and they've moved further out on the risk curve. People have chased yield. They want returns. They've gone into hedge funds, leverage loans, private equity, et cetera, commodities, emerging markets. They're taking a lot more risk than they think, and that may be the ultimate Achilles heel that gives us the guts of the next recession.
So in the 30 seconds we have left in this segment, tell our viewers, our income generation members, those over the age of 50, what you think is the #1 thing they need to know in order to protect themselves in the year or two ahead of us.
They need to take a much more cautious attitude than has worked for almost 10 years. And remember that cash can be king at certain times. If you don't want to be short, which has worked out very well for us recently, if you're a long-only investor, I'd have a lot of cash.
A man after my own heart. Long bonds, long cash, and short the stock market right now. Gary, we're out of time. Time flies. We're having fun. Thank you so much for being on the show. And you stay with us too. We'll be right back here with more on the Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. So in the midst of all this recent focus on the Fed, what exactly has changed for bond investors? Recently, a lot of the talk has focused on the possibility of a large drop in corporate bonds, or more accurately, a major increase in corporate bond defaults. This stems actually from a belief that corporate debt is dramatically high. I believe strongly that that fear is largely overstated, however, for several reasons. The first being that corporate debt isn't really much higher than normal. Yes, it's increased a bit due to a surge in stock buybacks, but it's important to understand that the stock market acts as a governor to keep the amount of corporate debt in check. You see, every CEO knows that his first fiduciary responsibility is to his shareholders, and that if his company starts taking on too much debt, its stock price could drop due to the perception of increased risk. This, of course, would not make the shareholders very happy at all. Rather than corporate bonds, I see a higher risk for default among municipal bonds, which very few analysts are actually talking about. And there are four main reasons why I believe the default potential is much higher among municipal bonds than it is for corporate bonds. First, there's no governing force to hold municipal debt in check the way the stock market reins in its corporate debt. There is no CEO of municipality, in essence, with a fiduciary responsibility. If municipalities are short of tax revenue, they can simply borrow more money and make up the shortfall. Number two, corporations can always increase revenue by selling more product, while municipalities don't really have any product to sell. Third, corporations can also get a handle on debt by laying off employees. While that's much harder to do for municipalities since their payrolls include necessary workers such like teachers, police officers, and workers providing essential services. And last but not least, there's an increased threat to municipal revenue right now due to the president's tax plan. You see, wealthy taxpayers in states like New Jersey, California, New York, Connecticut can no longer deduct their state income tax payments on their federal returns, which means that essentially the cost of their state income taxes has almost doubled. If a lot of those people decide to move to places that have no state income tax, it could mean a major loss in tax revenue for the states and towns that they leave behind. So, to me, if there's a default crisis brewing anywhere in the bond market, I believe it's much more likely to be among municipal bonds than corporate bonds. And if you think about it, much like the ratings debacle that occurred 10 years ago before the financial crisis when it came to mortgage bonds, I believe a lot of the municipal bonds today that are getting AA and AAA ratings don't really deserve those ratings. Again, much like the mortgage bonds going back a decade or so. Now, having said all that, I also want to stress that what I'm talking about doesn't constitute a so-called bursting of a bond bubble. And as I've discussed on other recent shows, the whole idea of a bursting bond bubble is a myth. Why? Because fluctuations in the bond market tend to be much slower and much more gradual overall than those in the stock market. The fact is that any U.S. collapse of the bond market has actually been a favorite prediction of pundits for the last 5 years. And their logic is simple. U.S. Treasury yields dropped so low in 2010 that there was little latitude for further decline of interest rates. The thinking is that yields simply had nowhere to go but up. And remember again that bond yields and bond prices move in opposite directions. If yields could only keep going up, then prices and values could only keep going down. Sounds sensible from a basic standpoint, but a lot is overlooked in those predictions. And what's more, forecasters knew that a key reason the yields were so low was due to quantitative easing and Fed setting holding interest rates near zero. It put artificial downward pressure on Treasury yields that would eventually have to be removed. Once it was removed, these pundits predicted that yields would rise sharply as prices fell. To them, it was just that simple. Only it's never that simple. It wasn't then, and it isn't now. Yes, yields have risen in conjunction with the Fed's tapering and the current unwinding of quantitative easing, and this has created some headwinds for bond investors. But it's hardly been a sharp increase, and I don't think that that's likely to change anytime soon. As I've noted, there's a strong resistance level in place right now in the bond market due to factors that I believe are fairly long-term, and we'll talk about that more in just a bit. And now it's time to welcome our second guest, Anthony Siccaro. Anthony is the founder and president of Providence Financial and Insurance Services in Woodland Hills, California. He's been in the business for approximately 20 years and has twice been named one of California's top financial leaders by Forbes magazine. He's a widely published author and a frequent guest on Fox Business News, CNBC, as well as other financial media. Anthony, welcome back to the show.
Hey, Dave, thank you for having me. Great to be here.
And of course, most importantly, I forgot to announce that you and I are actually in a study group together, and we're pretty good buds when it comes right down to it. So it's particularly my pleasure to have you here today. But I won't waste time on all the niceties, even though you are from the left coast, and people there tend to be a little nicer sometimes than us East Coasters. I want to get right to it because we've had a lot of newsworthy topics that we've had in the financial news so far this past week. So tell us, what do you make of all this market volatility that's occurred? What do you make of this so-called flattening yield curve? That started really on Monday, December 3rd. Educate us.
Yeah, so I think there's a combination of dynamics that are kind of all coming to head at the same time, kind of like the perfect storm, if you will. First of all, we're in record territory as far as this cyclical bull market is concerned. As of August last year, we've never had a cyclical bull market longer than we've had now. And just from a common sense standpoint, nothing goes up forever. We know that. Part of the reason why stocks have gone up, matter of fact, I'm going to argue that most of the reasons why stocks have gone up over the last couple of years especially has been artificial. I think if you go back 10 years ago, it started off artificially with quantitative easing, putting money in the system. That just messes with the normal cycles. And then the last couple of years, you've had stock buybacks that have created a demand for stocks that is completely artificial. And I think most people don't understand the effect that stock buybacks have had. And then you throw on top of that rising interest rates, and you've got all these things coming together, and it's just bound to lead to a stock market that's going to be ugly in 2019.
Yeah, a lot of these stock buybacks came from borrowed money, i.e. the issuance of more corporate bonds. But in light of all that, the rates have still stayed low in the corporate bond market, which is something I want to ask you about when we come back from the commercial break. So stay with us, Anthony, if you will, please. And you stay with us, too. We have a lot more here on the income generation from Dave Scranton and my good friend, Anthony Siccaro. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Now, if you're a regular viewer, you've heard me explain why I believe the current resistance level for long-term interest rates is likely to remain in place. There are several factors at work, but the one most relevant to this show is the fact that the largest demographic in the country right now is members of the income generation, the baby boomers at or nearing retirement age. Increasingly, folks like you across the country, are coming to understand how individual bonds and bond-like instruments can play a key role in helping achieve your income-based retirement goals with far less risk than conventional strategies, such as those that rely heavily on stocks or mutual funds, including bond mutual funds. And as large numbers of retirees and near retirees shift their financial priorities from growth to income, as I like to say, from the G to the I, they believe the overall demand for bonds will remain strong, strong enough to help keep prices and values up and most likely yields down. This, of course, means that one of the Fed's key challenges for continuing to raise short-term interest rates, the need for rising long-term rates, will remain in place for some time. But as I've explained before, I believe, like other analysts, that we may actually be entering an age in which low interest rates are the new normal, a situation much like Japan has experienced since the early 1990s. Even if rates do continue to gradually rise in the coming years, an investor with a diversified portfolio of individual bonds, whose goals are income-based, should feel minimal impact, especially if that portfolio is actively managed by someone specializing in retirement income. Remember, active management allows an income specialist to take advantage of growth opportunities when winds in the bond market are in his or her favor, as well as mitigate losses when facing headwinds. Now, as some of you know, I actually launched my own registered investment advisory firm, Sound Income Strategies, a few years ago, specifically because I realized that the 30-year trend of overall declining interest rates was about to end. I realized that active management was really the only way for investors over the age of 50 heading in the future to invest in bonds and bond-like instruments. And since then, more and more of them have also come to realize that is a truth. Again, actively managed income-based strategies are designed to help you achieve your retirement goals regardless of market conditions, whether that means record high stock market volatility, fluctuating interest rates, concerns about municipal bond defaults, a flattening yield curve, a new recession, whatever the current issue du jour might be. Why? Because they are strategies expressly designed to help protect your principal and to generate future income and grow your portfolio organically through strategic reinvestment of interest and dividends. But now it's time to welcome back Anthony Siccaro from Providence Hills, California. Now, Anthony, I appreciate you giving me that factoid that we set a record for the longest cyclical bull market in August. Because I've been saying we're near a record somehow, but I've been dancing around that because I just haven't taken the time to look up. But you know that we've hit a record then as of October. So we are now in the longest cyclical bull market, or at least until the last couple weeks it seems, huh?
Yeah, that's exactly right. And we know that no good party lasts forever. Nothing goes straight up forever. Nothing goes straight down forever. And I think there's reason to be concerned.
So how much of your concern stems from the Fed? You know, I've had this concern that the Fed creates a lot of recessions, raising too much too quickly. Do you share that concern, or do you think there's other factors out there that are bigger than the Fed?
Well, there's certainly a lot of factors that are of consideration as well, too. The Fed certainly has a big paw in the sand bucket as well. But the reality is that the challenge is as the Federal Reserve starts to raise rates, it gives the stock market competition. With the interest rates being so low for so long, really investors have had nowhere else to go for yields. You could go get a 1 or 2 or 3% dividend somewhere else and do better than you could anywhere else. But with the 10-year Treasury, staying at 3% for the last couple of months and now dipping down below, it's given competition and certainly is going to affect the stock market if the Fed keeps raising rates.
So that's one way. One thing, of course, the flow of money out of stocks into interest-bearing investments. Now, those look more attractive. But how about the economy overall? We had 4.2% GDP in the last quarter. It was closer to 3.5%. You think we're going to maintain that, or do you believe that 2019 we're going to slip back down in that 2% range?
Yeah, I don't think that we can maintain that. That's certainly something that can happen quarter by quarter. And don't get me wrong, things are better than they were a decade ago for sure. But the reality is a lot of the numbers we hear are artificial themselves. Unemployment's not in the 3.7 range. That they don't count the millennials. They don't count people that have been unemployed, that are no longer getting a check. They don't count the baby boomers that want to work but can't. The consumer price index, that's not real. That's an artificial number. That doesn't count things like food. So it sounds
like you're questioning actually how the GDP is calculated in part also, which I'm going to ask you about more. We need to take another commercial break. So you need to leave it there for now. We'll be right back to ask you about that. And you stay with us, our Income Generation members. Dave Scranton and Anthony Siccaro will be right back on the Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. You're here with David Scranton and Anthony Siccaro. So Anthony, of course, man after my own heart, I know from our study group that we're in agreement that the unemployment rate is truly understated when they factor in long-term unemployed people. And we're also a little skeptical of the GDP growth, the inflation numbers. And just this week, what do you make of the report just this week that came out where the Federal Reserve actually said that they believe that the inflation rate based on other factors is less than what's been published recently?
Well, essentially, the Federal Reserve just said what you and I have been talking about for the last 10 or 12 years that we've known each other, and that is that these numbers are artificial. And when it comes to the GDP, one of the things that's going to have a huge impact as far as moving forward is concerned is the interest rates rising, and from a level that we haven't talked about a lot, and that is that for every quarter point that the interest rate rises, it costs the government another $50 billion a year in interest because we're now $21 trillion in debt, and that's going to hurt GDP. They don't want to raise rates, but they're kind of stuck. They have to, but they can't, and the stock market's reacting to that.
Yeah, and the yield curve's flattening, which, as you and I've talked about all the time, is a big warning of a recession. But in the last minute and a half or so we have left, I want to focus more on individual investors, our income generation members, our viewers, those over the age of 50. What do they need to do to protect themselves in an environment like this?
Well, I think you want to be super careful, first of all, and knowledge is power. And most people that are over 50 have never invested in income-producing investments. It's all been growth and stocks and mutual funds. And if you're invested that way, but you need income, then you're forced to sell shares to get the income you need, and you cannibalize your portfolio. Hook up with someone that knows how to invest in income because it's a completely different strategy and philosophy than the way you've always done it.
So in other words, investing for the I, not the G, because sometimes you invest for the G for growth and you get L, you get losses. So in 30 seconds then, tell us how, you're out in California, you're on the opposite coast from me. How's that message? Is that message ringing in people's ears, or are they still struggling with it, or is the stock market volatility over the last couple months helping them absorb and accept that message?
Yeah, so most people that have been in the market over the last couple of years actually have had a hard time accepting that message. But anytime volatility picks up like it has, that message rings truer, and our phones are ringing off the hook because of what we've been telling them for the last couple of years.
Okay, so you're seeing it come around. All right, that's great. And it probably helps that you're over there on the left coast, and most of them agree with you that Trump's economic plan is not going to sustain that 4% GDP growth. And that makes them more conservative by nature. But we've got to run. Anthony, thank you once again for being part of the show. And you stay with us. We'll be right back here on The Income Generation. I'm David Scranton. I'd like to thank both of our guests for joining us for another episode of The Income Generation. Of course, I'd also like to thank you, our new and returning viewers. You know, on today's show, I use the analogy of a tightrope walker, but I also once described the Fed's current challenge as trying to land an experimental airplane in the midst of a storm. Now, that could be more accurate, actually, because we should all think of ourselves as passengers on that plane. We're really not just observing, we're participating, whether we like it or not. If the plane lands smoothly, it could mean the economy will keep chugging along at a healthy pace and the stock market will stabilize after maybe a year or 2 years of record high volatility. If it crashes, however, meaning the Fed raises rates too soon or even just says the wrong thing, it can mean a new recession and the third devastating market drop since the turn of the century. As passengers on the plane, it's really up to each of us to decide how to handle the situation. Is it smarter to bet on a smooth landing or to perhaps prepare for the worst, just in case? Most rational people would typically take the second option over the first. And I certainly would agree. Now, with that in mind, there are a few takeaways from today's show that I'd like you to consider. The Fed's challenge isn't likely to get any easier in the coming year due to a wide variety of factors, between the ongoing trade war to the possibility of shrinking inflation, as well as the threat of a fully flattening yield curve. It's also all about understanding that there's no real such thing as the bursting of a bond bubble. Even though we may indeed be on the brink of a municipal bond crisis per se, doesn't necessarily mean it's got to affect the bond market systemically. In fact, I believe it most likely wouldn't. And finally, it's important to understand that actively managed income-based financial strategies are, again, designed to help you achieve your retirement goals regardless of market conditions, whether it means that stock market volatility, rising interest rates, inflation, or whatever the issue du jour might be. These are all things to think about as you consider whether or not it makes sense to buckle up. Thanks for watching. If you're close to retirement, you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here's where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.